China is openly talking gold higher. It's so obvious. And it used to be hidden, used to be stealthy, no longer. Following Trump's comment, he said, "Who has the gold makes the rules." Well, that was a tweet. That if the financial war does escalate and or a military war ensues, and that is plausible, even if it's a proxy war, Trump's comments may grossly backfire. China's nuclear option would be to reveal the real extent of their unencumbered PBOC gold holdings, dwarfing the unaudited, likely rehypothecated US Treasury gold holdings. And as we discussed in detail last time, and still missed by the mainstream media, I haven't seen it anywhere with other market commentators. As the US-China trade war risks escalating into a once-in-a-century financial war, China's anchored BRICS payment chains are rapidly onshoring, providing sufficient liquidity to also digitize. And as we talked about it last time, I re-raised it, Glaziev fully beta-tested BRICS-facing gold-backed commodity currency. Now, our Asian liquidity providers figure this will ultimately result in a global gold price quoted in RMB, because that is where the main links are, forcing the local London AM and PM dollar fixes to quote these prices ultimately. This is very big news. It means de-dollarization in a big way. It will completely reset the world order. So step by step, China is really revealing its very strong hand. Following opening up gold futures trading to Chinese citizens and institutionals, we've looked at it multiple times. On the 1st of March, exactly 6 months later, in October, the PBOC opened up foreign firms to be able to trade industrial metals on the Shanghai Futures Exchange, undermining the pricing power of the LME. Now, exactly 6 months later, and 1 year after opening up the Shanghai Futures Exchange gold futures trading domestically, the PBOC is moving to open up Shanghai gold market overseas warehouses to enable gold settlement of gold and silver and platinum, shifting the market sway from the West to China. This is the final leg of them putting this whole strategy together. Trump has attempted to push back. One phone call and they'll be back on the dollar is what he said. However, look, with the dollar already weaponized against China, Russia, and Iran, and given that the sudden expansion of tariffs equals sanctions, and these nations control the lion's share of global commodities, the US has very little additional leverage over China and Russia's expansion of their alternate non-dollar settlements. And to sum up, what we're witnessing is a major de-dollarization move that is seemingly or probably deliberately ignored by the mainstream media and official channels. Maybe they don't understand it. It's being ignored that the PBOC announced its digital RMB, and it's already been connected to, this is why it's amazing that it's ignored. It's been connected to 10 Asian and 6 Middle Eastern countries. That's already facilitating 38% of global trade that is able to bypass the weaponized SWIFT payment chain. Unbelievable this is ignored. And while the United States is still debating whether digital currencies threaten the status of the US dollar, which they don't, in my view, 87% of nations, that's 200 countries, have already adopted the digital RMB. Cross-border payments have already exceeded 1.4 trillion US dollars and growing. And while this scope of RMB settlements are limited, they are growing. However, add in the ability to digitize Glaziev's gold-backed stablecoin as a 7-second ruble settlement currency, these volumes are about to exponentially explode. These are the liquid payment rails that Glaziev beta-tested gold-backed currency. And remember, we talked about that beta testing. That's 2 years ago. And then we saw this failure at the BRICS summit to employ anything. It made a great deal of sense, perhaps not to deploy it at that time. But it's going to facilitate BRICS members, nations who trade, as I say, 85% of global commodities that they produce or consume amongst themselves. So to have a gold-backed currency. Lavrov has also promised access to alternative payment platforms for non-BRICS members. So this is being opened up for non-BRICS members too, referring to the financial messaging system of the Bank of Russia. Now, the digital RMB BRICS payment bridge is not only a multinodal, multipolar global payment tool, but also a technical carrier of the Belt and Road strategy. It enables the build out of the digital Silk Road, and it provides access to the Northern Sea route in instant settlement. And all of these moves are part of a strategic plan for China to stick handle BRICS nations to become one global benchmark price setters for all commodities. Revealing the PBOC has taken its kids' gloves off, along with Russia, are now in a position to consolidate these BRICS-centric markets.
You'll understand why the global monetary chessboard has fundamentally shifted, and why gold isn't just reacting to geopolitics anymore. It's driving them. China's no longer hiding its hand. In fact, they're openly walking the world into a gold-backed, multipolar monetary regime, right under the noses of Western institutions too distracted or too compromised to admit it. Let's get something straight from the top. The PBOC is no longer whispering about gold in backrooms. It's speaking in full voice, through policy, infrastructure, and now full-spectrum settlement architecture. Gone are the days of stealth accumulation. We are now in the era of strategic revelation. Now, why does that matter? Because China's moves in the gold market are no longer about reserve diversification. That was 2010's strategy. Today, it's about monetary weaponization, with gold as the anchor. Following Trump's now infamous Truth Social post, "He who has the gold makes the rules," China is setting up to do exactly that. Make the rules. Trump might have meant it as bravado. But in Beijing, they're treating it like prophecy. And here's the danger. If financial warfare escalates and the US continues to use the dollar as a weapon through tariffs, sanctions, or exclusion from SWIFT, China's nuclear option is to reveal the true scale of its unencumbered gold holdings. Let me be clear. If China were to disclose that it holds 20,000, 30,000, or even 40,000 tons of sovereign, unrehypothecated gold, much of it quietly siphoned from London and Switzerland, it would instantly destroy confidence in U.S. gold reserves, which haven't been audited since the Eisenhower administration. And that's no conspiracy. That's just math. And let's not forget, this isn't just a battle over reserves. This is about the pricing power of gold itself. We're seeing the birth of a new global benchmark, and it's not coming out of London or New York. It's being engineered through the Shanghai Futures Exchange, and the shift is almost complete. Let's look at the sequence. March 2024. China opens domestic gold futures, trading to institutional and retail investors through the Shanghai Futures Exchange. October 2024. Exactly 6 months later, PBOC opens access to foreign firms for industrial metals, further undermining LME's dominance. March 2025. 1 year after gold futures opened domestically, China begins onboarding overseas warehouses into the Shanghai Gold Exchange, enabling international physical settlement in gold, silver, and platinum. This isn't some vague trend. It's a step-by-step dismantling of Western commodity price control. Each 6-month window brings a new structural shift, and every shift pulls more liquidity, more trust, and more participants away from London and into Shanghai. Meanwhile, the mainstream media? Silent. U.S. policymakers? Oblivious? Or pretending to be? But the facts are screaming. BRICS is building something massive. We've known for years about the BRICS currency idea, but what's becoming clear now is that the infrastructure is ready. This isn't about meetings and press releases. This is about hard rails. Digital RMB settlements are now live across 10 Asian and 6 Middle Eastern nations, bypassing SWIFT and routing directly through cross-border RMB corridors. That's 38% of global trade now capable of sidestepping the dollar. Right now, not in theory, in production. Even more critical, China is preparing to tokenize gold through its state-backed infrastructure. That's GLASV, the beta-tested BRICS-facing gold-backed stablecoin architecture we exposed 2 years ago. This platform was never scrapped. It was simply strategically delayed, likely until the system was ready to absorb the capital inflow that comes from a failed Western reset. Now, if you think this sounds like monetary science fiction, ask yourself why central banks, led by China, have bought more gold in the past 2 years than at any time in modern history. Ask why the LBMA's registered inventories are collapsing. Ask why COMEX deliveries are up, not down. Ask why JP Morgan delivered $4 billion in gold into COMEX for an unnamed client this February. You think that's for fun? This is about prepping for a revaluation event, one where the BRICS bloc becomes the benchmark setter for global commodities, starting with oil, then metals, then eventually food. And here's what's missed in all of this. Pricing control is monetary control. If you control the price of oil, wheat, copper, or gold, you control trade settlement. And if you control trade settlement, you control what currency is necessary. And if that currency is gold-linked, well, then the dollar's done. And that's not a warning, that's a forecast.
As we have just witnessed in this period we're now delving into, it regularly sets up the COMEX casino pit managers for both an upside and a downside two-way rinse, into which they control. Now, the lion's share of non-Basel III compliant US-facing CTA investments are populated in the gold exchange traded funds. We've done lots and lots of reports about how they work, how they're not one-to-one backed, etc., etc. But they track the gold price. So that's really what these funds are doing. And that being the case, as far as these funds' balance sheets are concerned, namely which are the cashable assets required to be funded against their liabilities, simple, these funds have to treat gold as another tradable, high-quality liquid asset. But it's like any other commodity which employs a required stable funding, a discount of 85%. So in other words, it's discounted. So it's only, it can only be valued at 85% of what is shown. And as we've been drawing frequent attention to, unlike every other global facing exchange, these US facing leveraged gold positions are not Basel III compliant. In other words, due to this balance sheet haircut, ETF gold investments don't qualify as a first year asset that can be one-to-one exchange for physical gold or cash. Big difference. Unlike global liquidity providers, servicing the non-stable funding, the net stable funding compliant foreign exchange markets, who, if they are called upon for delivery, must one-to-one deliver spot gold at the benchmark fixed prices on a T+1, a one-day basis, whereas the US-facing CTAs have to apply a discount to the gold they hold in the gold futures or related ETF long position. Now, by design, aside from generally disincentivizing non-yield bearing gold as an investment alternative for these traders, rather letting them chase after stocks and higher risk asset classes, it sets these investors up for a regular bid-pulled COMEX rinses. Now, bid-pulled in the sense that no bullion bank, nor even the Fed, wants to expose themselves to adding short positions they cannot offset against these speculators. They're not stupid. I mean, China's taking everything that's on offer, as are BRICS banks. So, however, as far as Basel III global NSFR compliant deliverable FX market making bullion banks are concerned, they must one-to-one have the bullion on hand to deliver when called on to do so at a benchmark spot fix, where foreign central banks, sovereigns, institutional buyers are one-to-one able to exchange their respective FX currencies for an equal weight of bullion without any discount. The paper to physical disparity, this paper to physical disparity sets up the regular wash and rinse cycles where an NSFR compliant bullion bank can gain a balance sheet advantage against these non-physical holders. The Bank of International Settlements enables a zero risk weight to these bullion banks' gold positions. And I will stress physical gold held at the bank or held in another bank on an allocated basis. In other words,
so let's connect the final dots here. Because if part one laid out the roadmap, this is where we arrive at the destination. It's no longer theory, it's deployment. We are witnessing live the end of Western price control in gold and commodities, and the reemergence of physical settlement as monetary truth. Let's talk about this critical move. The PBOC's push to open overseas gold settlement via the Shanghai Gold Exchange. This is not just an expansion, it's the final pillar in a multi-year blueprint to move physical bullion into the monetary system, outside the hands of the US Treasury and outside the manipulative reach of the LBMA and COMEX. Here's what this really means. Western contracts, like those traded in New York or London, are derivative claims. They're backed by fractional reserves, rehypothecated to the point of absurdity. You've got, at best, 36 million ounces in deliverable gold standing behind 280 to 300 million ounces in open contracts. That's a roughly 8-to-1 leverage ratio. In silver, it's even worse, 2.9 billion ounces traded daily in London versus maybe 260 million ounces of unencumbered silver in the entire LBMA vault system. And half of that is spoken for by ETFs. So what does China do? They don't play that game. They've said, we will not participate in paper price setting. We will offer a physical alternative. And now they're allowing foreign institutions to settle in real gold through approved overseas warehouse partners. That completely changes the game, because now a global miner or sovereign can bypass London and sell into Shanghai for physical yuan-settled gold. That yuan can be digitized. That digitized token can be traded for any commodity along the Belt and Road corridor. That is not a theoretical threat to the dollar. That is replacement infrastructure. And when Trump says one phone call and they'll be back on the dollar, he's missing the point. There is no going back. China is not just building alternate rails, it is connecting most of the world to those rails. Nations have had enough of weaponized finance, enough of getting cut off from SWIFT, enough of being told that settlement only counts if it clears in New York. And let's be clear, gold is the unlock. Why? Because in a fractured world, trust is broken. Dollar-backed debt is no longer neutral, but gold is. You can't inflate it, you can't sanction it, and you can't rehypothecate it once it's moved. That's why BRICS nations are moving fast to monetize physical gold, not in speeches, but in rails. Cross-border trade in the digital RMB just passed $1.44 trillion. That's not a projection. That's done. Already settled, already cleared. Now imagine what happens when GLASV, the gold-backed stablecoin beta tested by the BRICS nations 2 years ago, goes live. It'll act as a ruble-like gold settlement tool, and the beauty is, it's already plug and play. Lavrov has said it will be extended to non-BRICS nations, using the Bank of Russia's payment rails. The implications? A digital gold settlement layer for over 85% of global commodity trade. Gas, oil, wheat, lithium, you name it. No dollar required, no treasury yield necessary. Just a token redeemable in gold, settled in 7 seconds, off-chain, via distributed ledgers with commodity-backed collateral. This isn't the future. This is being quietly deployed while CNBC talks about meme stocks and Bitcoin ETFs. Let's put it all together. The LBMA is losing physical, the COMEX is losing credibility, the BRICS are building rails, and gold is the thing that connects the dots. Now you'll hear the skeptics say, gold is outdated. We've moved past that. Number, we haven't. You think Beijing is spending hundreds of billions of dollars on gold accumulation for fun? You think Putin's Russia is adding gold to its strategic military stockpiles because it's nostalgic? These countries aren't romantic. They're preparing for war, financial war. And when push comes to shove, they know that the side that wins is the side that can settle trades in real money. This is why China's next move, revealing the true extent of its unencumbered central bank gold holdings, would instantly undermine U.S. monetary credibility. The market assumes the U.S. has 8,133 tons, but that figure hasn't been independently verified since the 1950s. If the PBOC discloses 20,000 or 30,000 tons, that ends the game. The dollar's days as reserve currency wouldn't just be numbered, they'd be over, because price is confidence. And if China shows it has the gold, and the U.S. can't even prove its bars exist, the shift will be rapid. Central banks would dump treasuries overnight. Dollar debt would freeze. BRICS would quote oil and RMB. And gold? Gold would gap higher overnight, not because of demand, but because of distrust. And that's where we are. Gold is no longer reacting to geopolitics. It's driving it. So here's what I'll leave you with. Don't wait for mainstream confirmation. Don't wait for Wall Street to figure it out. They won't. They're trapped in a model where paper settles paper and gold is a trade, not money. But that model is breaking. It doesn't matter what the COMEX price is. It matters who can take delivery. It doesn't matter what the ETF inflows are. It matters who controls the rails. It doesn't matter what the dollar index says. It matters who holds unencumbered gold and who has the infrastructure to price it. And as of now, that's China. So whether you're a retail holder, a fund manager, or just someone trying to survive this storm, ask yourself the only question that matters. Do you own the asset or do you own a promise? Because in this new world, the only thing that matters is what settles. And gold settles everything. And let's not forget how this resets the mechanics of price discovery itself. Western pricing models are built on liquidity, on the assumption that you can always roll over futures, always find a counterparty, always access a dollar-settled mechanism. But once physical settlement becomes the norm, that liquidity dries up. The BRICS aren't interested in margin calls. They're interested in ownership. And the moment physical flows are redirected through Shanghai, the price no longer references Western contracts. It references available gold, not forward contracts, not backwardation charts, just deliverable metal. That subtle transition, pricing to settlement-backed metal, is seismic. It's not just about gold, it sets precedent. Once a nation settles oil and gold, or wheat and digital RMB, the market adjusts. You'll hear traders say, but there's no market depth for that. But markets follow volume, and BRICS has volume. Once 10%, then 15%, then 25% of global trade starts clearing via Shanghai, that becomes the new benchmark. And legacy exchanges like the LBMA will be left quoting irrelevant prices no one trusts. They'll be relics, fittingly, like their own vaults. And look, this is no longer just speculation from the sidelines. It's showing up in clearing data. The rise in Shanghai gold premiums over London spot isn't a technical glitch. It's a physical arbitrage window. When gold in China trades consistently $30 to $50 above London, it's a sign. It means gold is more valuable where trust is higher. It means capital is willing to pay for exit velocity from the dollar system. That's a reverse Gresham's law. Good money, real gold, pushed out bad money, paper claims. And once you see that trend hit scale, the rest of the system follows.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.